Good afternoon, everybody. It is Monday, March 29th, Stocks of the Week, and we are going to get some banging in this show because they're still working on my roof, still getting the shingles put up, 4-unit condo building. So if you hear banging, that's what it is. But all right, so I was going to focus on SPACs this week. Instead, we're going to split it up. We're going to talk about CBS, Viacom, and Discovery, which both got hammered because a family office that runs a hedge fund got out over their skis in leverage and had to start liquidating things. And when they started liquidating, their investment banks really kind of pulled the plug on them. So you had Morgan Stanley selling all kinds of shares over the weekend, all kinds of shares getting sold on Friday. When the initial stock declines began to occur, and we're talking 27% down on both of these on Friday, and then more today, and pre-market in particular. Looks like it's been stabilizing. CBS, Viacom, actually it's ViacomCBS in the 40s. I actually took a starter position in ViacomCBS. I haven't bought Discovery yet, but I might. So let's make this a play on words, a Discovery, ViacomCBS. Somebody has a show out there called A Discovery of Witches. So I don't think it's either one of them, though. So let's talk about what's going on here. Both of the stocks got hammered. And, you know, if you've been watching ARK Innovation Fund get hammered for the last month or two, you should understand by now that these types of corrections in a market that was pumped up by liquidity and FOMO chasing can come down real quick. So when you see charts today like we did, you ought to be woken up out of your FOMO, I would hope. And we take a look at this, and we just look at 1 month here. I mean, let's take a look. I mean, that's a huge decline, well over 50%. Just look at it for the last 5 days. You know, it's falling off a cliff from up near 100 down to under 50. And there's a lot of stocks that have been doing this. We saw OnTrack do it, seen Teladoc do it, we've seen a bunch. So I think hopefully we're past now the point where people are telling me, well, I need to get my money invested. Not if you're going to buy things that are overvalued. There was just an interview out today on Bloomberg where they talked about, hey, fundamentals are starting to matter again. And where have you heard that before? As liquidity comes down, fundamentals are going to matter more and more. And what we know is that the central banks are slowly pulling liquidity, right? They don't want to blow the market up, but they don't want to live in la-la land any longer, you know, if they don't have to. So we need to remember, in the short term, stock market is a popularity contest, but in the long term, it's a weighing machine. You better start learning how to use your scale again if you forgot all about it. So the sell-offs in Viacom, CBS, and Discovery, I think, are both new opportunities. I think one is better than the other. So let's talk about that. I am slapping a buy rating on Viacom CBS for a number of reasons, which I'm outlining in this article. It's not quite done, so I'm not done with the Discovery part yet. But I believe that Viacom CBS is going to be one of the 5 must-own streaming services, along with Netflix, HBO Max, Disney, and Peacock. And those are going to be services that you pay your $50-$60 a month, and you have those. Those are going to be the places where most entertainment comes from in the future, because they have the studios, they have the delivery, they have the finances, really the momentum going for them. And I think that you're going to see the old networks essentially emerge. And who are the old networks? Well, Disney is ABC, Peacock is NBC, Paramount Plus is CBS, right? Then they all have a movie studio. You have HBO, which is Warner, then Netflix, which is like the giant independent. So going into Paramount Plus, which launched on March 4th, the company already had 30 million paying customers, mainly through CBS All Access, which is now Paramount Plus. And they are expanding aggressively internationally. Company pays a dividend. They're buying back some shares. They did a secondary offering last week before this all collapsed because of that hedge fund. And maybe that was the match that lit the sell-off wick, right? They diluted, it blew up this guy's positions, which were all leveraged. So they raised another $2.7 billion to go along with the $3 billion they had on hand. The company is profitable and they're paying down debt. You know, their shareholder yield is getting better and better. So that's something that if you listened to it already, the podcast I did with Meb Faber last week is up on Seeking Alpha in their podcast section, but it'll also be in an article. So I put it in the chats. But shareholder yield, what is that? That's the combination of dividends and buybacks minus debt, everything net. Companies that can buy back shares on net, remember, because they can issue shares to executives too. So on net, are they buying back shares? Are they paying out dividends? And are they able to reduce their debt? Well, ViacomCBS is doing all three. That's great. And now they're through the merger process. It cost them some money and jacked up their debt numbers. Now, people take a look at this. They go, look at that debt that went through the roof. Oh my God. Yeah, but that was the combination of the debt of two companies. That's from Viacom and CBS merging. Then what do you see? That came down. $1.6 billion in a year, in the last year. Huge, huge difference. Right? Compound annual growth rate on operating cash flow, 8%. CapEx suddenly, not so bad. So I think you really need to take a look at ViacomCBS. If you are a dividend investor, this is probably something that's going to go back up to the prices they were at. It'll just take several years now. It won't be the rocket ship, liquidity-driven thing, but you know, you have value investors. You have a lot of people in there buying those millions and millions of shares that became available over the weekend and late last week. That's in addition to the people who bought the secondary. So we are finding the price where this is attractive to a lot of big investors because the blocks out there are big, big blocks. And they're negotiating that price, and it seems to be in the 40s. It's where it is now. So I would tell you, if you think that you're going to see more consolidation in this space and revenues go up and up as streaming services come online and the death of the cable package is imminent, you know, and now be a streaming package. There will be streaming packages out there. I think Roku's going to put all these on their platform. If they're not already there, I think they're all there already. And they might have like a menu, right? They might just have a menu, a check mark thing, pops up on your screen. You know, do you want Netflix and HBO Max and Disney and Peacock and Paramount Plus? Here you go. And they might even work out discounts. Buy all 5, get 10% off of each. I'm sure these guys would all do that. Amazon, you know, the platforms are going to sell these services. And there's going to be some jockeying around. But Paramount Plus's content is pretty off the charts good, right? Their goal is sports, news, and entertainment. And they have some of the best sports contracts out there. And CBS News is a big deal. There's been rumors of CNN merging with them. We'll see if that happens. I don't think that it will. I don't think it makes sense for Warner to give that up. It just doesn't make any sense to me. I would take a look at CBS Viacom because the charts are telling a pretty interesting story. In the middle of the day today, in the chat rooms, I put this chart up. I said the 4-hour chart is bottoming. And it's been jitterbugging ever since. There we go. Easier to look at. Look at that. Here's your crush. It's starting to find some support. Huge blocks of stock selling in here. Huge. Look at that. Where this comes out to. It's a lot of shares selling. That is the big brokerages who got stuck liquidating these shares on margin calls, finding buyers, and this is where they're finding them. Middle to low 40s. What did it close today? 45.30? Yeah, my guess is that it dips a little at the open today or tomorrow, and then it comes back. So I think you can sell puts on this. But I think you should own shares because that dividend just became a lot more attractive. I think the yield's over 2% now. They're going to start spitting out a bigger dividend over time. They'll do their little raise every year. What they're really going to do is as this cash flow comes in, when Star Trek comes back on, they have 2 Star Trek series that are very popular. And that's what any of these networks need, is a couple of big programs that keep people involved. One of the unfortunate things that I did a lot the last year is watch a lot of TV. This is going to be one of your winners. And when it was up here, I didn't like it. Talked to you about it when it was back in here. Then it went nuts. There you go. It's not so nuts anymore. I wouldn't miss this one if I were you. Okay, that's about as close as I come to banging on the table. So if you go through all the charts that I'm putting out tonight, you'll see that this is probably worth buying. Now, Discovery is a little bit different. If you're aggressive, I think you consider it. They don't pay a dividend. They buy back some shares, though. What they really are is a basket of content that is world-renowned. Discovery Channel, Animal Planet, Food Network. They're getting into international markets. Discovery in Spanish, Eurosport. They just did a big soccer contract. This company too, sports and entertainment. I don't really know what they do for news. That might not be a big deal to them. They might not care. The news is everywhere, right? They might do some niche stuff. Maybe one of these that I'm not all that familiar with does it. You take a look at them, what you see is that all their ratios are in pretty good shape compared to the S&P 500 and the industry in general. Better price to sales, better price to free cash flow, better price to book, better EV to EBITDA, and then their EV to EBIT, which is also referred to as the acquirer's multiple, or what you look at to figure out what a takeover price would be. It's only 13.3. Compare that to a PE ratio that's higher. So this is a stock that probably go up 50% to double in a takeover. Why are they a big deal for a takeover? Well, again, take a look at the content they put out. In a consolidating market where streamers and bundle producers and platforms are going to have to try to figure out how to split up that $50 to $150 a month that each household is going to put into this. I'll probably be towards the top end of the 150. I guess there's probably some people who spend more than that. But 50 to 150 is about what most people are going to end up spending on streaming and platforms. Roku and Amazon are practically free. So it really comes down to what you're going to pay for streaming and how are you going to get your local sports, your local channels. I told you before that I buy the Spectrum streaming service, and then I buy the separate streaming as well. So Spectrum is costing me whatever it is, 50, 60 bucks a month, and I'm spending another 50 or 60 on streaming services. Plus I have Amazon and Roku. Why do I have both? Because Amazon Prime. I don't really buy anything off of Amazon Prime on the content side. I get all kinds of products through them. And then I got Roku because we bought the TVs. And like I said, I don't really know where that goes in the future. Roku has a lot of execution risk. They have to do things right, and maybe they will. But open platforms aren't hard to copy. They just got there first. And there's an old saying that you don't necessarily want to be the innovator, you want to be the person who's second. Let the innovator make all the mistakes and then copy them. So I think there's a lot of copying of Roku company. In any case, I think that Discovery is going to get aggressive bidding for this company at some point. Aggressive bidding. And if you take a look at who owns certain shares, you see with Discovery, some of the big owners, one of them is a trust. It's set up for estate planning. That was in here a second ago. This is a estate planning trust. 14% of the company. Guess who that is? I haven't looked it up, but I'm guess. In any case, tells me that there's a strategic transaction coming. Here's another one of those companies that's set up for it. You take a look at where they are in the market, how many subscribers they have. Right? They only have 5.2 million streaming subscribers. They have 220 million viewers. What does that tell you? Tells me a lot of people like this stuff. They're running out of money to put into streaming services. So I think one of these companies that I mentioned earlier, Netflix, AT&T, Disney, Peacock, Viacom, Comcast, right, owns Peacock, or Amazon, or Roku, or Google, or Facebook, or Apple. These are all companies that could be bidders for Discovery. And I actually think that Google, Facebook, and Apple are the logical bidders. I really do. So we'll see. I'm not so sure that Roku and Amazon don't want to be bidders. I'm just not sure that if Google, Facebook, and Apple get in the game, what's the point of bidding? You're not going to beat Google, Facebook, and Apple if they decide they want to write a check. And Discovery is only an $18 billion company. So even at $25 billion, it's pretty easy to digest. Warren Buffett said he's looking for a company in the $30 billion range to buy. He already owns a bunch of Liberty. There's already a Liberty SPAC out there. Interesting number, interesting content. So if you're aggressive and you're a growth investor, I think you can take a look at buying Discovery. I think pretty much everybody should buy ViacomCBS. So let's jump over to the SPACs. I didn't get this done today because I got upended by this Discovery and Viacom thing. But I've been looking at the SPACs. And specifically, I've been looking at recent IPOs that are pre-deal and the share price is low and they meet all of our other criteria of big pile of money, fairly well-known underwriters and issuers with good focus and good management, and they're in the right types of markets. We're looking for the sorts of investments that we think are in our barbell. So here you are, $10.25 on a common stock, $10. Where's Guggenheim? Interesting. This one's interesting. No units, right? No warrants. I like that. Why do I like no warrants? Why do I like it? Because they're not begging for money. They're just basically telling you we're going to make a good deal. You don't need us to bribe you. So that's why I told you a long time ago, you're looking for a small number of warrants, not a big number of warrants. Guggenheim's coming with only 1/5. Kozla Ventures, Vinod Kozla is one of the best entrepreneurs in the world, right? Sun Microsystems, a bunch of other things. No units, 1002, 990. And Cadia, I'm not so sure if I'm interested in another Fertitta one, right? We already own the one that we own fast. I'm not so sure that I need this one. They both have quarter warrants, so I kind of throw those out. This one with Michael Dell, right? Looking for tech, only 1/5 of a warrant. I like that. $10 a share. Some of these are pretty interesting, so I'll make a list of these for you. But there's one in particular. And here it is right at the top, ArcLight. What did I tell you is one of the things I liked about certain SPACs? They had insiders or management who were what? Connected in what part of the world? Who were insiders where? In zoo foundations? No, it would be zoo foundations. Big deals with the museum industry? No. Big deals in government. Oh, yeah, government. Come on, folks. A little quicker with the keyboard. Dr. Jason Audrey Lee, former VP at Sunrun, co-chair of the Clean Energy Initiative for President Biden. How much more of an insider could you be than to work for the current president? So this one's at about $10 right now. Only 1/5 of a warrant. Pretty good pile of money. Looking for something in renewable energy and energy transition. Why wouldn't you buy this? Almost 100% backed by the money in the trust fund. You're getting an insider with the current administration. You think they won't make a good deal? So this is one of the ones that I'm saying you really ought to buy, ACTD. Will be in the list tonight. There's a few others. 1/3 warrants. I almost throw those out universally. No units, as Dragoneer ones we mentioned a second ago. There's about 8 of them that I found that can add to the 8 that we already have out there, in addition to the 3 stocks that we own that used to be SPACs. So if we're lucky, 2 or 3 or 4 of these end up being home runs. And the rest of them, maybe we just break roughly even on. I'd be okay with that. That's why you buy the whole basket. Now, you can also buy SPCX, which is the ETF that I did the interview with Tuttle on a couple weeks ago. That chart is pretty interesting. Look at that. Set this box up. Here it comes right into the box. Starting to get big buyers. And with all of these ETFs, with all of these SPACs now down around $10, this ETF has very little downside. It's given back almost all of the excess gains on the pre-deal SPACs. There's really very little downside on this. Why? Again, because the SPACs are backed with cash. So if some of these deals pop, he gets to make money, and the rest of them he breaks about even on. And he can hold them, until the momentum breaks. He did that with CCIV, Churchill, the one that bought Lucid. He rode it up, ended up getting, I believe, $17 or $18 a share on it from 10, which wasn't the peak, but it's actually a little bit worth a little bit more than it is now. So he did a pretty good job trading it. And some of these are going to make deals that are a big deal. So this is a good alternative asset, right? Because they're not really stocks. You got to cherry pick them yourself for after the fact, after the mergers. But up until that point, you pretty much have highs and wins. If you're a chess player, you could either tie or win every game, and it's for money. Why would you stop playing? Why would you stop playing any game where the 2 possibilities are tie or win? It's like playing the shell game. And if you pick up a shell with no ball under it, they let you play again. And if you pick up the one with the ball under it, you win. Good shell game to play. So that's where we are right now with all of these SPACs. So cheap. We take a look at all the searching, all of these. Just go right down the common price. 9 something, 10. Look how many of these are right around $10 in the 9s. Altimeter is one of them, ones that we talked about. 1163. We should probably revisit this one. Notes here. Take a look at this one. That big premium that it had has largely gone away. So you start taking a look, you go, wow, all these, look at how low their prices are. It's almost no downside. And remember, when Tuttle or you sell your shares in a unit, you get to keep the warrants. A lot of cases, you're getting those warrants for almost free, which is why I told you on the front end, buy the warrants, I told you on the front end, buy the units, not the shares. Buy the units, you have rights to the warrants. And if you redeem your units, you get to keep the warrants. Free money, right? Or free lottery tickets. If somebody said, here's 100 free lottery tickets for your birthday, hey, how many of you have gotten lottery tickets for a birthday? They're like, well, hey, it might be my lucky day. You don't feel bad about that. There's always a $10 winner in there. You never know. I hit the jackpot. So I'm going to finish these up tonight, both of these articles. I need to take a nap as soon as these guys are done pounding, though. So I'll figure this out. Somebody asked about ARK, covering ARK. Well, I did that already. So go here, already broke down ARK there, and then did it again here. So I've done it a couple times. This is somebody else's. They were talking about it. But I did it here. And there's an article that talks about some of these ARK things as well. One stock that was brought up in the question was Teladoc, and it's basically where I told you I would want to take a look at it. Here's my problem. ARK just changed the rules to allow them to take more risk, to be more concentrated, and I'm a little concerned about that. So let me think about that. I'm not so sure that I want ARK to be 100% in charge of the share price of a stock I own. I don't like, so you go and check the news, but I don't like that ARK is getting rid of their ownership limits on certain stocks. Not only the amount of the company they can own, how much of it they can put in their fund. So they're removing those caps, and they're getting very aggressive in SPACs. So keep an eye on that. And I'm going to take a look at their transactions today to see what SPACs that they're buying, because I get the transactions in my inbox. So if we can find something around 10 bucks a share and they're starting to buy it, there you go. There's your one with low risk and potential good upside. So I'm going to take a look at what ARK has been buying in the last week and today, because like I said, I save those for usually a week or two. But if you ever want to see what ARK is buying, go ahead and sign up with their website. They tell you every night. They have a full report. All right. Any questions? Are there any thoughts on battery tech and the videos I posted in chat? Well, so QuantumScape is the one that I'm really interested in, because that is the best technology if, it doesn't explode. So if they are able to solve for the fire problem, it is probably going to blow away that one that got brought to market in a SPAC last week. I'd have to check the name. It had a funny name. Was it Evenix or something? But I was looking at all those technologies in the battery tech, and what was the thing that I said on Friday? Usually the tech with the most potential is the one that wins. Why? Because something that has the potential of a zillion versus something that only has the potential of a half a zillion, the scientists and the companies will figure out how to get the one with the zillion potential to win. They'll figure out how to make it work. And we are at a point right now, and I don't know that people fully have their heads wrapped around this, but we are in the home stretch. I mean, we're in the 6th or 7th inning of what we need in battery technology to have it just blow away fossil fuel vehicles. We are almost to the point, we're 1 or 2 generations away, but probably one, where we can have batteries that go 600 to 1,000 miles on a charge, are half the price of the existing batteries, and they last 1,000,000 miles. Now, will batteries get better after that? Sure, but that's not what we need. What we need is the 600 to 1,000 mile battery, charges mostly, 80% charged in 20 minutes, doesn't explode, is half the price of the existing batteries, right? That's what we need. And we are, right, we're in about the 6th inning there, right? The starting pitcher has got us to the middle of the game. Now we're just trying to figure out, do we need a setup guy and the closer or just a closer? That's how close these batteries are getting. And if QuantumScape battery works, if they can figure out how to overcome the fire potential, that battery is what I just described. Evenix, I think the other company was Evenix, right? Ajax merged with Kazoo. I don't know much about Kazoo. Got a little bit of a bump, 1066. Market not super excited about it. So I would probably, I'm going to look at splitting my shares, selling the shares, and keeping the warrants. Yeah, I don't know anything about Kazoo. I got to look it up. Let's go to my handy dandy here, document search. Tell me about Kazoo, online car retailer. Yeah. Yep, I'll read all about it. Remember 2 years ago, probably, if you're with me back then, I talked about buying a couple of used car lots where I would buy one-owner cars, then help people buy cars online. And at the time, I knew Amazon was coming to market with something. But Amazon does this too. So I take a look at this and I'm like, there's competition here. So I don't know how big of a deal this really is. So I'll probably split my shares, split my units in Ajax, and sell the shares, and then hold on to the warrants to see if there's more upside in this than I think. One thing to keep in mind with all of these is that I was just reading on Reddit. The Reddit kids are starting to look at these SPACs a little bit more seriously. And go back to the first thing we talked about, this Discovery and ViacomCBS both have pretty high short interest. So now that the shorts have made all that money, it'd be pretty easy to squeeze them out with any type of pressure at all. And I would expect that the Reddit army is going to come for those stocks, especially Discovery. They grew up with that. So not a lot of risk left in ViacomCBS or Discovery. Not a lot of risk in any of these SPACs that are trading at cash value. Margin of safety investing, people, right? What are the most important words in investing according to some of the biggest investors in history? Look for a margin of safety. Get a huge margin of safety with Viacom and Discovery at these prices. And with these SPACs, these prices are just screaming, roll the dice here. You don't need to know what the deal is. That's not the point. Yeah, if somebody says Carvana has done well, that's kind of my point. How much money can a whole bunch of online retailers make? Take a look at the margins at Amazon. Amazon doesn't make big margins, but they've had this period where almost nobody challenged them, which always blew my mind. Shopify is getting in there. Guys like me are building our own websites with open source software, right? Etsy, eBay. Everybody's starting to close the gap. Online shopping. We're going to come full circle where it just becomes the brand. Whose brand product do you want to own? That's what it's going to become. I buy my green tea from Costco now. Why? Well, one, I told you, Costco's like our once a month date. To go to the store, walk around, see if we need anything, get a little chicken, buy a bag of Caesar salad mix, try all little samples of things that we're not going to buy, get a couple giant cases of soda, our allergy pills. But where are you going to shop online? And if you got 7 billion people doing it, but there's more and more competition, right? Profitable businesses draw competition. Well, once the competition is in, what differentiates one player from another? In most cases, nothing. So margins go down because they have to compete on price. Amazon's got an advantage because A, they're huge, but B, they got the entertainment. So they throw in the entertainment platform. Now they have grocery delivery. So in any case, I do think we're at peak Amazon. I just maybe it grows slow, but I don't think you're gonna see massive growth there anymore. And until they unwind AWS, I think there's only one pop left at Amazon, and it might come after it drops. We'll see. I'd buy Amazon around 24, 2,500. In any case, Kazoo, Carvana, Amazon. They're competing with Amazon. Whoever else is coming out there. Yeah. Not exciting to me. I don't see what their moat is. What's their moat? What protects them? I don't think they have much protection. All right, I'm gonna let you go. Get this edited. I'll get these 2 articles finished tonight. And then tomorrow morning we're gonna sell some puts, I think, on a whole bunch of stuff. All right. Have a great night. And I'm also looking for a couple of swing trades. I'd like to get that ready. All right, take care.